Good morning from Chicago, traders. Thanks for joining me again today. Trading futures, options on futures, and foreign currency involves substantial risk of loss and is not suitable for all investors. My personal opinions, market data, and recommendations are subject to change without notice. Past performance is not indicative of future results. A quick look at the overnight news and activity. Key element pushing the European markets. German May industrial production misses by quite a lot. Negative 1.8% month on month versus zero expected. It's at 1.3% year on year versus a consensus of 3.6. So quite a bit lower. Gold and the treasuries seem to be driven by a Goldman Sachs report that's bringing forward the forecast for the first Fed hike. Now Goldman is predicting Q3 of 2015 versus Q1 of 2016 for the first hike. The Fed funds rate will increase to 4% by 2018 is what's expected. That would be interesting to see. So again, Fed fund rate by Goldman's forecast would be 4% by 2018. Government forces recapture Slavyansk in eastern Ukraine, a former rebel stronghold. Separatists forced to leave positions along northern front. Government forces now reportedly planning an offensive on Donetsk, the only major city still held by rebels. So that seems like the Russians have kind of turned their back on these separatists, and it's allowing the government, the Ukraine, to go in and capture the territories back taken by separatists. So it seems like that problem is going away temporarily. J.P. Morgan cuts Q2 German GDP growth forecast 0.5% from 2%. So we're seeing a reaction in the European indices as they've been selling lower. ECB's curse says Eurozone growth is very weak, and sees it that way for a period of time. As far as what's on deck for today, nothing on the calendar really today. We only have a 3-month auction for 25 billion, a 6-month auction for 23 billion that comes out at 10:30 Central Time, 11:30 Eastern. And then looking out for the week, we're seeing tomorrow another light day. 9 o'clock we have the JOLTS job openings. At 2 p.m. we have consumer credit, Fed's Lacquer, Fed's Kosher Lakota. Wednesday, 6 a.m. MBA mortgage applications, and at 1 p.m. Fed minutes from the June 17th and 18th meeting. So not very much going on there. Let's look at the charts to see where the market is. Let's talk first about what it has done. So we'll look at our short-term trigger chart for that. Because Friday was a holiday, I've eliminated the data from Friday. We just did a scrub on the holiday. So what you're seeing here is Thursday. Thursday was kind of interesting. Open auction out of range, it gapped up. This is Wednesday's range here. It gapped up. It tested. It had a responsive seller early. If you recall, Thursday, the primary idea was for an attempt lower to push down towards 70 or even 68, 50 before finding buyers to rotate up. And then the target for Thursday's primary hypothesis, was 78.75. As always, you can always go back and watch those videos on YouTube to see what was said before the market versus what actually happened. I think that's you could probably it'll help you put the puzzle together a little bit better as far as how I'm viewing things, which is not to say that that's the right or wrong way to do it. It's just an approach. So we tried to 71.25, so pretty shallow, could not close the gap, could not go down to the range. No test of the prior day's value or anything, even though it was a very tight, very Gaussian textbook-like profile. push to 75, pull back to the open, push to 75 for a double top week high, and then it broke lower to 71, 71.50 for almost a double bottom. Again, another test of 75. The combined tests of the 75 make this an important line. So I put in a note here. The key LVN for Thursday is 75. That's the number that I'm going to watch for the over-under for today. Consolidation, some pretty good coiling and compression, and then the market breaks higher and ends up pushing to 78 and a quarter. Again, the target for the measured move is 78.75, just 2 ticks short, and then it sat sideways before the point of control shifted up to the top of the range. We have a very poor high at the high before the market closed at 12:15 that day. So the market never had an opportunity to create an excess high or to test the high. So the expectation was for a higher high on Thursday's set. Friday didn't go anywhere. It just kind of sat sideways. I don't have Friday's data in here. I actually don't know Friday's high. I don't recall what it was. But overall, the market has opened in yesterday's and the Sunday session as usual at 5 o'clock Central, has gone sideways, tested towards part of what was left behind on Thursday night, and then it's sold off. It's basically pulled back to 71 and a quarter, which is where that low was that we tested on Thursday morning. So we've pushed to 78 and a quarter. We've tested the entire range of Thursday. Okay. Not much to glean on the overnight profile. Looks kind of messy. Volume is very, very light. 98,000 versus by now it's expected to be at about 190,000, 195,000. So it's about half of what it normally is. Welcome to summer trading. So as I said, not much to glean from the overnight profile. Hardcore market profilers would look at this as the inventory is short. The inventory for the overnight session is short. So the expectation is for a short-term correction up on the open as inventory balances. So here we are, 1973 trading right at the bottom of the value, although there is no real value here, but we're back into the meat of what we did on Friday. The overnight low at 71.25 against 71.25 low of Friday with the OS low. We still have a gap between 70 and 71 and a quarter below us, but the expectation is for this to test 75 on the open, test towards 75 on the open before we see what the short time frame players are wanting to do today. With nothing on deck for economic releases and so forth, I'm expecting this to be a fairly quiet day. If anything, it might push the 71.25 down into 70 and land somewhere in the 67, 67.50 point of control here back into the zone. But that's really all she wrote. Remember also that 71.25 was the non-farm payrolls high that was released on Thursday morning. Okay, so that's where we leave on Friday. New highs for the year: higher high, higher low, higher point of control, higher value. So long-term, intermediate-term, short-term, day time frame, all those time frames are bullish. Okay, are pushing higher. It's interesting because when we look at what the market condition is, it's clear that all time frames are up, and overnight it's been generally the inventory has been either balanced to long, and then there's a slight balancing on the open, like a quick sell-off or whatever, and then the inventory for the day is long. But as we look at what the market has done the questions we seek to answer here is, you know, what has the market done? What what is it trying to do? How good of a job? And then based on that, we can answer the question, what is likely to happen next? Some of the questions you want to answer what is likely to happen next is, which side has more work to do to change the pattern or behavior? In this case, it's the sell side. Which side has is on the path of least resistance? That would be the buy side. So that's what helps shape your bias, and then with that, then it's easy to then narrow down your choices to, okay, if my bias is long, the market's long, what areas do I want to pay attention to take along with the bias? Or if my bias or time frame is really short and I expect a quick push down on the open or whatever your hypothesis is, then the only question remaining is, where do I interact with the market? What area do I hit to get on the short side? It kind of cleans things up a little bit versus someone who comes in and just says, well, you know, I know we've been going up, but it's moving down. The moves down are my favorites, and therefore I'm going to look for any reason to sell short, even though I know it's moving up, and I'm not going to hold on to it. And what happens is, because there's no context or perspective on the bigger picture, it's very, very difficult to get out when things are not working, because you start to give a position a chance, give it a little bit more room, and then as you give it more room, you get deeper in the hole, and as you get deeper in the hole, it becomes incredibly difficult to take the loss, because your expectation then becomes, well, I'm going to take, it's gone so far, how much farther can it go? And if I take the loss, it's probably going to go a couple more ticks and then turn, and I'm going to feel really bad, and my monkey doesn't like to feel bad, so I'm just going to hold on to this. Okay, so I see that a lot here in live trading through a lot of the traders who are working hard to make a career out of this, and I can tell you that that's the single most career crusher to have that happen. Overall, the big picture, we've been one-time framing since the 26th, higher low, higher low, higher low, higher low, higher low. Even if it's a lower high, we're still one-time framing up because there are higher lows. This chart here shows my measured moves. You can see the measured moves and where they're forming, the little triangles. And you can see here 78.75 is our target from the most recent measured move, which ties 1750 to 60 to 36.25, projected up 100%, 78.75. Then there's a secondary measured move from way back right here. This one here projected at, I think, 200% or something like that. So those are the two measured moves that play out in this area at 79.75, 78.75. So the numbers I have above us are 78.75, 79.75, 2000, which is a psychological number. 2000.5 is a measured move right here, 2000.5. Okay, it's 162% of the gap move. Pull back to 1750, 2000.5, and then 2005 just above there. That's what it seems like the market's targeting. It's the next area up. Of course, the Dow made all-time highs the other day at 17,000, and the market's having a bit of a pullback now. But overall, I expect that the market will have two-sided action today, both forces in play. There's plenty of incentive for buyers to continue to buy, but there's, you know, given the overnight action, there's incentive also for sellers to look for these areas below to be tested. The other thing about this move up, so the good news on the move up is that the long-term players, the bigger players, the fund managers and so forth, are participating in the market because they know that in general the Fed is standing behind them, right? The Fed is doing whatever it can to keep the markets elevated, which is unfortunate because that usually results in a bubble and a bubble bursting. So with the all-time frames up, it just seems like there's no reason, and there's no reason to be in cash. You're not going to maintain your clients if you're in cash. So it seems like fund managers are participating on the long side. Value keeps moving up with the action here. So if we get not only price action, but if we look at this bright pink line, it's moving up. Value is being accepted higher and higher and higher. It keeps moving up with every session. And we have a major target above at 2,000. In addition to that, the market has not really made a clear excess high here, right? This is an excess high right here. See this? I don't know if that's clear or not. But if the market pushes up and immediately falls off because it finds sellers, because that's what its job is, this is considered an excess high. This new high a year here, 47.50, comes in, and we have an excess high. Sellers step in and take it back down. That's a fairly healthy high, and it took some time for the market to get back up there. It took the Fed to push us back up through there. But it gave an opportunity for us to experience the other side and pushed right through. I think this was the ECB, I think. To push right through and down to retest some weaker areas. So this is a nice spring cleaning here. This is what we want to see the market do. We want to see action on both sides of the market, even though one side's dominant. But since then, we've had markets pushing up and not leaving any excess highs. Very poor highs, as you can see here in this balance zone. This is a poor high. There's no excess at 60. So the expectation, as you recall from prior trader bites, is that that 60 is not likely to last, and that's what we've left behind here. We don't see an excess high. See how blunt this is? The market did not reject these prices immediately, so the expectation is that we continue higher. Okay. Selling is very weak. It does not seem like selling is sustainable. Every time we sell off, buyers find that to be an opportunity to step in to buy long. The risk seems to be, even though it's risky to get short in any time frame but a quick scalp or a very, very short time frame, as prices go up, the risk scale kind of tips over and it becomes riskier and riskier to buy at new highs because you have more room to go down than potentially room to go up given the market structure. That's not the truth in general, but this is what it seems like. It seems like we've left a lot of areas of incomplete auctions below, and so as we push towards 1200, I think we're likely to see less and less participation from buyers. I think they're probably going to sit on their as we push into that level. The volume, as we have seen over a long period of time now, since last November, the volume lifting the offer is just not there as the market pushes higher. As the market goes up, as you see these prices, these bars go higher and higher and higher, we're not seeing the same in the volume delta. The volume delta remains firmly negative since the peak, so new highs are being made almost on a short time frame basis. There are no real strong hands coming into the market and pushing prices up and holding those prices. So there's no aggressive behavior on the buy side. There are many other risks to the move higher. The profiles do not look the way they normally do for a proper auction. We don't see a continuous build. If you look at these profiles, we don't see a this is a fairly healthy profile here, but we don't see a a consistent build, a fattening profile that's moving up before the day ends. We see sleepy trading, pop, and then another blurb up top, another lump of volume up top. Sleepy trading, pop, another lump up top, right? And so that's what we had on Thursday. Sleepy morning, pop, another lump on top. That's normally the markets will auction in a back and forth, but building value higher, building value higher, building value higher. That's a market, that's a two-way auction where prices are thoroughly tested and the auction is orderly. We're just not seeing that either. This is more of a quiet, pop, hold, quiet, pop, hold. So we'll see how that shakes out. It does not mean that this rally's over by any means. We have to take what's on the screen and trade that rather than our opinion. So this morning, the primary hypothesis is for a choppy open auction in range, back and forth. I want to see what happens on the test of 75. Overall, the market has cleanly pushed through on the upside, has found buyers. But if it pushes to 75, fails, and starts to test the other side of the opening swing, then my expectation is for a test of 70 and then 67, 75, 67, with a pause potentially at 68.50 or so, 68, 68.50, given this balanced profile. So this may be a time for it to pull back. So my primary hypothesis is for it to push to 75 and then be faced with some eager sellers to try to test lower into this NFP range, potentially to 68.50 or 67.50 to close this gap, chop, 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 and then potentially find its buyers into the close as it's been doing for quite some time. If not, then because the inventory, the overnight inventory is short, then the expectation is for the market to attempt lower and then for the inventory to balance out, push to 75, and then again I'm going to be eager to see what happens here at 75. Does it blow through or does it fall back through and then form a base? So if the market opens and it chops sideways and it forms a strong base, you need to be looking for signs of things like double tops, triple tops, and so forth at 75 like we had on Thursday, and then it's likely to pop through to push to 77.50 again and potentially to 78.75 to finish that move. We still have the week high. The low does not look like an excess low, but it's not a weak low either. So the most likely scenario is to chop around, and then essentially the primary or the secondary hypothesis are pretty much equal in probability, in my opinion, because it could chop around, break the 75, and then get to 77.50, and then 78, 75, 79, 75 to finish those measured move targets as expected, or it could chop around and then roll over to close the 70, 67, 50. I think the push lower is less likely than the push up, given the conditions that we have, including the inventory, the overnight inventory being short. I'll leave you with that. That's a lot to take in. Remember, it's the beginning of a week. It's a full week of trading. This is the day to set goals. It should have been yesterday, actually, but this is the day to set goals for the week so that you're working towards some strategy or some goal to help you pick your trades and decide on risk. Take the time to do that if you intend to do this as a career. Take care, and I'll talk to you soon.